Imagine you are watching this video just before the market opens at 9 a.m. What I am about to tell you could save you from losing money today. But if you ignore this and trade between 9:15 and 9:30, you might make one of the biggest mistakes of your trading journey, because what I am going to reveal is not found in any indicator or trading course. It is not sold in premium communities and it is not shared freely on social media. It is a hard truth most traders only understand after losing money. Have you ever experienced this? The market opens and price starts moving aggressively in every direction. One moment you see profit on your screen and the next moment it disappears. You place a stop loss but it gets hit within minutes. And right after that the market moves exactly in the direction you expected. You sit there confused, frustrated, blaming the market, blaming your broker, blaming news events. But the real problem is never the market. The real problem is timing. For a long time I believed the first 15 to 30 minutes of the market was the best time to make money. I thought this was the most active and profitable window of the day. But what actually happened was very different. I would take one trade in excitement, then another in fear of missing out, maybe a third one trying to recover losses, and by midday I was emotionally exhausted and financially down. Here is what I did not understand at that time. The first 30 minutes of the market is not designed for clear trading. It is designed to create confusion. Big players are not interested in direction at that time. They are interested in liquidity. And that liquidity comes from emotional traders reacting to fast fear, greed, confusion. These emotions dominate the opening minutes. Most traders believe they are analyzing the chart, but in reality they are reacting to emotion. Ask yourself honestly, have you ever entered a trade in the first few minutes just because a candle moved quickly? Not because of a plan, not because of confirmation, but just because it looked like an opportunity. If yes, then you are not alone. But that habit is exactly what causes repeated losses, because in the opening minutes the market is not stable. It is building a temporary range, it is collecting orders. It is creating traps for early entries, and most traders walk straight into it. The biggest mistake is thinking the opening move is the real direction. In most cases it is not. It is a test, a shakeout, a liquidity grab. And once this phase is over, the real direction begins. Now before we continue, you need to understand something important. This is not about predicting the market. This is about understanding behavior. In the next part, I will show you why the first 15 to 30 minutes destroys most traders and how news, emotions, and early volatility create a powerful trap that repeats every single day. The first 15 to 30 minutes after the opening bell are often called the opening range. This is when price moves rapidly up and down with very little commitment to a true direction. Many traders mistake this movement for opportunity. In reality, it is often nothing more than noise. The purpose of this opening range is not to reveal where the market is going. It is to create liquidity. Every buy order, every sell order, every stop loss placed by emotional traders gives institutional traders the liquidity they need to build larger positions. I learned this lesson the hard way. One morning, the market opened with a strong gap higher. Within minutes, large green candles appeared on the chart. Everything looked incredibly bullish. I convinced myself that the rally had already begun. Without waiting for confirmation, I entered a long position. The trade moved slightly in my favor for a moment. Then the market reversed just enough to hit my stop loss. Seconds later, price exploded higher without me. I sat there watching the move I had predicted unfold perfectly after I had already been forced out. That moment changed the way I looked at trading forever. The problem was never my analysis. The problem was my timing. Early price action is often filled with false breakouts, fake momentum, emotional buying, and emotional selling. The opening gap does not automatically tell you where the market will go. It only tells you where the market opened. Many traders see a gap higher and immediately assume the market will keep rising. Others see a gap lower and panic into selling. Professional traders know better. They understand that the market often moves against emotional traders before revealing its real direction. Now think about your own trading. How many times have you rushed into a trade because you were afraid of missing the move? How many times did that decision lead to an unnecessary loss? The truth is simple. The market rewards patience far more often than speed. Instead of trying to predict every opening move, allow the market to reveal its intentions first. When you stop reacting emotionally and start waiting for confirmation, your trading begins to change completely. But the opening range is only one part of the problem. The next trap is even more dangerous because it starts before the market even opens. It begins with headlines, social media, breaking news, and the powerful bias they create in your mind before you place your very first trade. Before the opening bell, most traders are already making decisions without realizing it. They read financial headlines, scroll through social media, watch market commentators, and listen to predictions about what the market is supposed to do. By the time the market opens, their mind is already biased. If the news sounds bullish, they believe the market must go higher. If the news sounds negative, they expect prices to fall. This is called pre-market bias, and it quietly influences every decision that follows. Once that belief takes hold, the brain starts looking only for evidence that supports it. A single green candle feels like proof that the prediction was correct. Several red candles are dismissed as temporary noise. Instead of following price action, traders begin defending their opinions. That is when small losses become much bigger ones. I remember one morning when every headline was optimistic. Global markets were strong. Analysts were predicting a positive session. Everything suggested the market would continue higher. When the opening bell rang, I was already convinced the only smart decision was to buy. The first candle closed green and my confidence exploded. Then the next candle turned red. I ignored it. Another red candle appeared. I refused to accept that I was wrong. My stop loss was hit. Instead of walking away, I immediately entered another trade trying to recover my loss. That decision had nothing to do with strategy. It came from frustration and ego. Revenge trading rarely starts because of money. It starts because your mind refuses to accept being wrong. The first 30 minutes make this even more dangerous because emotions are at their highest. Your confidence is fresh, your expectations are high, and your patience is usually at its lowest. News does not make traders wealthy. It creates excitement, and excitement often leads to emotional decisions instead of disciplined ones. Professional traders understand that headlines attract attention, but price action tells the real story. That is why they never allow news alone to determine their trades. The market does not reward opinions. It rewards discipline. In the next part, I will explain how opening volatility is designed to trigger stop losses and why waiting just a little longer can completely change the outcome of your trades. Now let's talk about one of the biggest reasons traders lose money during the first 30 minutes of the trading day. It is not because they cannot read charts. It is because they underestimate volatility. Opening volatility is different from normal market movement. Price can move sharply in both directions within seconds. Large candles appear without warning. Breakouts fail almost immediately. Support and resistance levels seem to disappear. Most traders believe this is normal price discovery. In reality, much of this movement is driven by liquidity. Institutional traders know exactly where retail traders are likely to place their stop losses. They know where fear turns into panic, and they know where excitement turns into impulsive buying. That is why the market often moves just far enough to trigger those stop losses before reversing and continuing in the original direction. I experienced this myself. One morning, I entered a trade only minutes after the market opened. The setup looked perfect. Price moved a few points in my favor. Then it suddenly reversed and hit my stop loss. Within minutes, the market turned around and rallied far beyond my original target. I was right about the direction, but I entered at the wrong time. That single lesson completely changed the way I approached the opening session. Instead of trying to catch every early move, I started waiting for the market to settle. The results improved almost immediately. One simple rule made the biggest difference. No trades during the first 30 minutes unless every condition in my trading plan was fully confirmed. That rule eliminated emotional entries, reduced revenge trading, and protected my capital from unnecessary losses. Many traders worrying that waiting means missing opportunities. But that fear is exactly what causes poor decisions. If the market moves without you, another opportunity will come. Capital can always find a new trade. But once capital is lost, recovering it becomes much harder. Professional traders understand that preserving capital is more important than chasing every move. In the final part, I will show you what experienced traders actually do after the first 30 minutes. You will learn how they identify high-quality setups, why patience gives them an edge, and the simple mindset that separates consistent traders from emotional ones. If you have made it this far, then you already understand something that most traders never do. The market is not trying to reward the fastest trader. It rewards the most disciplined one. Many beginners believe professional traders make money because they trade more often. The truth is usually the opposite. Experienced traders spend more time watching than trading. During the first 30 minutes, they are not rushing into positions. They are studying the opening range. They are watching how price reacts around important levels. They are paying attention to volume. They are waiting for the market to reveal its true intention. Only after the opening volatility begins to settle do they consider taking a position. By then the market has already provided valuable information. False breakouts become easier to recognize. Support and resistance levels become clearer. Risk can be measured more accurately. That is why patience becomes a competitive advantage. One of the most important rules I ever adopted was simple. If I feel an overwhelming urge to trade, as soon as the market opens, I do nothing. That feeling is usually driven by emotion rather than logic, and emotional decisions rarely lead to consistent profits. Can you trade successfully during the opening minutes? Yes, but only if you have a proven trading system, years of experience, strict risk management, and the emotional discipline to accept losses without changing your plan. For most traders, the better decision is to wait. Observe first, trade second. Remember this, the market will always create another opportunity. You never have to chase one trade because there will always be another setup tomorrow. Protecting your capital is more important than catching every move. Successful trading is not about predicting the future. It is about managing risk and making disciplined decisions over and over again. The market does not reward excitement. It rewards consistency. The next time the opening bell rings, ask yourself one question. Am I reacting to emotion or following a proven plan? That single question can save you from countless unnecessary losses. If this video changed the way you think about the market, then it has done its job. If you enjoy honest trading psychology without fake promises or guaranteed profits, subscribe to the channel for more videos focused on discipline, risk management, and long-term success. Remember, the goal is not to win every trade. The goal is to stay in the game long enough to become consistently profitable.